Today we're reviewing a financial analysis report on TNYA Therapeutics titled TNYA Stock, High Risk, High Reward, Honest Review.
Right, it's looking at that recent, pretty severe drawdown and trying to figure out what's next. So let's just dive right in.
I think the core idea here is really compelling, that the market reaction was, maybe an overreaction.
It's a great thesis. So our goal here is to give some actionable feedback to really elevate this, to take it from a solid assessment to something more like an institutional grade argument.
I see that. And that tension, that balance between getting attention and maintaining credibility, that seems to be the first big opportunity.
Exactly. So our first piece of feedback really focuses on aligning the tone for maximum analytical credibility.
Okay, let's unpack that.
Well, the attempt to balance a sort of high-energy, almost clickbait title with the promise of an honest review, it creates this tonal inconsistency.
Right.
And that risks undermining the report's credibility, especially for a more sophisticated recipient.
So the weakness is really in the language itself. I'm seeing phrases like absolutely bleeding right now, and this idea that everyone is panic selling.
Mm-hmm.
And while I get that it's meant to create excitement, it really clashes with the kind of objective rigor you'd expect from a deep financial analysis.
It really does. I mean, if your target reader is someone who understands preclinical data, who knows drug trial phases, they're going to flinch at language that sounds more like a Reddit post.
It suggests the analysis is driven by shock, not by calculated insight.
Absolutely. So the suggestion here, the improvement, is to refine the report's style, align the language completely with that promised analytical depth.
Let the data provide the drama.
Yes, exactly. The excitement should come from the risk-reward setup itself, which is already there, not from, shouting about volatility.
Okay, so let's make that concrete. How do we rewrite that hook without losing the reader?
So we replace the emotionally charged phrasing with objective, data-driven language. For example, instead of, "This stock is absolutely bleeding," you could say something like, "The stock has experienced a severe drawdown, specifically a decline of 37% in the past 5 days." Or even just, "TNYA is trading at a significant discount to its recent public offering price."
That immediately establishes the facts. But what about that hook, that sense of urgency? The panic selling narrative is powerful, even if it's a bit much.
You replace it with something more powerful for a savvy investor. You focus the intro on the institutional disconnect.
Ah, okay.
I mean, that's the real story. Sophisticated institutions just bought millions of shares at $1.20, and now retail investors can get them for 80 cents.
That's the arbitrage opportunity.
That is the hook. That gap between institutional confidence and the public market price, it's just far more compelling than saying the stock is crashing.
So you're shifting the focus from market emotion to valuation disparity.
Exactly. It frames the entire piece as a calculated opportunity, which is perfectly in line with an honest review. It tells the reader, institutions saw value at this price a week ago. Here's why you're getting a discount.
I like that. It immediately elevates the analysis. Okay, so moving on, let's get into the substance, the risk section.
Right. This is biotech, so the clinical data is everything. It's the engine of both the risk and the reward.
And our second piece of feedback is aimed right at that, at deepening the fundamental clinical risk analysis.
Yeah, this is where we really need to dig in. While the report does a good job identifying dilution and volatility, the financial mechanics of the crash, the analysis feels incomplete. It doesn't really explore the fundamental clinical uncertainties that actually drove that negative reaction to the TN-401 data.
So the weakness here is that the report says the crash was because investors got good but early data instead of perfection.
Right.
But then it just pivots straight to the reward catalysts without really detailing why the data wasn't seen as perfect. What were the scientific hurdles that are still there?
And that leaves a huge gap in the honest review promise. For a high-risk biotech play, an investor absolutely has to know what they're betting on in the lab.
You can't just treat the market reaction as an emotional disappointment.
No, it was a reaction to specific scientific ambiguity. And to miss that is to miss the whole point. So the suggestion for improvement is to bridge that gap.
Without turning it into a scientific journal, I assume.
Of course, but you have to strengthen the risk section with a concise, high-level summary of what the specific clinical ambiguity was. What were the limitations in the data they released?
Okay.
This is what turns a vague idea like a mixed reaction into a concrete, measurable element of risk.
So how does that change the calculation for the person reading this? If you get more specific on the clinical data, what does that change?
It could change the entire valuation model. If the issue was, say, the duration of effect was shorter than a competitor's, that completely alters your peak sales projections.
Sure.
But if it was a small safety flag that just needs monitoring, that's a manageable risk. It might delay things, but it doesn't kill the drug. The reader needs to know the difference to weigh that risk.
That makes the risk tangible. So for concrete examples, looking at the TN401 section, instead of just saying reaction to data,
You could add a sentence or two explaining what endpoints the data left unanswered. Was the sample size too small on a key secondary endpoint? Does that mean they now need a bigger, more expensive trial? That's real, actionable risk information.
and what about the other drug in the pipeline, TN201?
We absolutely have to talk about that. The report mentions the FDA lifted the clinical hold, which is good, but what does that mean?
Right, the significance.
Is it just a procedural clearance for them to submit a new application, or is it a green light to actually start a phase 1/2 study tomorrow?
Because that difference could be months of lead time and millions of dollars.
Exactly. Grounding these risks in the actual clinical pipeline, that's what validates the whole analysis. It shows it's based on informed speculation, not just looking at stock charts. If the risk section feels scientifically rigorous, the reward section becomes so much more believable.
We're trading that superficial excitement for structural integrity.
That's the goal.
That's incredibly actionable. Okay, let's pivot now to the bull case. Section 2, the reward. I can see why it was structured this way. Analyst targets are always tempting. But let's talk about how to make this section stand on its own.
I think the third key issue we found is that the report's bull case structure is it's overly reliant on external analyst validation.
Which makes the core thesis pretty fragile.
Potentially very fragile. Yeah.
The report makes a good case for the upside, but it leads with the analyst view. It anchors the whole argument on that H.C. Wainwright analyst maintaining a buy rating with a $3 target. That 275% gain is right up front.
And that heavy emphasis is the weakness. It makes the entire analysis feel like a reaction to the analyst, not an internally generated assessment of the company's actual value.
So if that analyst drops coverage tomorrow,
The whole report's main thesis is instantly weakened. We saw it happen last year with that tech stock, right? Major firm drops coverage, investors panic, even though the company's fundamentals hadn't changed at all.
the goal should be that the reader believes the analyst because your report made a strong case, not the other way around.
Exactly. So the suggestion for improvement here is to completely reorient the structure of the bull case.
Okay,
It needs to prioritize the internal, tangible catalysts that the company actually controls, specifically the cash runway and the institutional confidence we just talked about,
And then use the analyst target as
powerful corroborating evidence at the end, not as the foundation.
So this is really a sequencing change. It's about moving away from leading with the big, exciting number and leading instead with the most fundamental point of security.
100%. So for concrete examples, you restructure Section 2 to lead with the most immediate, company-controlled positive, that $60 million raise.
Because that secures the cash runway into the second half of 2026.
Yes, and that is the single item that removes the immediate risk of insolvency. Without that cash, any talk about future clinical success is just, it's moot.
that cash runway buys them the time they need to get to the next clinical milestones, which is the only thing that really matters in the long run.
Precisely, so you start there. Then you follow that up by emphasizing the institutional vote of confidence.
The fact that major investors just paid $1.20 a share.
Yes, days ago. These are sophisticated players who did their diligence and put real capital at risk at a much higher price than where it's trading now. That signals a true belief in the long-term value.
And only then, after establishing all of that, do we bring in the analyst.
Only then. Finally, you introduce that $3 analyst target as strong external confirmation that yes, institutional research also sees this stock as oversold.
So you're framing it as validation of the intrinsic value you've already established.
The analyst target becomes the cherry on top, not the whole cake.
And restructuring it that way makes the argument so much more durable. The core thesis about TNYA's runway and the institutional backing would hold up even if that external coverage changed.
Right. It's the difference between a reactive report and a proactive piece of analysis.
We want the person who reads this to walk away thinking, this report understands the deep intrinsic drivers of this company's value, not just the headlines.
Exactly.
So,